Hello and welcome to NetInvestible. Today I am going to discuss the strategies required to withstand market volatilities. I thought this is the right time to discuss on this topic given the current market situation we are in. Many questions I am getting these days what we should do in terms of our investments because market is so volatile. So to discuss the appropriate strategies to shield your investment in a volatile market is what we are going to discuss today. Before we discuss these strategies, let us understand what is market volatility. Generally speaking, it is the rate at which the price of a security, a stock, a bond fluctuates over a given period. Volatility of financial market is the extent and frequency of price movement, normally resulting from various economic uncertainty, geopolitical issues, sudden changes in the investor sentiment, etc. While market fluctuation in the short term causes nervousness, observe the volatility is a part of investing. Rather than reacting excessively, in my view, the investor should view strategies with risk and return without compromising their long-term financial goal. Now, let us see what are the strategies work best during the volatile market situation. So, number one strategy is to apply diversification to your portfolio. Diversification as your first shield to your asset. The portfolio of the most successful strategies to confront volatility is diversification. We know that. By diversifying assets among classes such as equity, government securities, gold, even foreign markets, bonds, liquid funds, etc., investors diversify away from being overexposed in one particular sector or geography to many. For instance, while equity market correct during times of recession, gold and government securities are safe haven investment during those times. A diversified portfolio makes sure that winner in some classes offset the losers in other classes, which help to overall achieving overall return in your portfolio. Number two strategy would be asset allocation and rebalancing. The importance of asset allocation and asset rebalancing is of paramount importance. Keeping the right asset allocation according to your risk tolerance and time horizon is the most relevant in unstable times. Young investor can absorb more equity exposure, while those nearing retirement would prefer to take the path of stability through debt instrument and secured fixed income securities. As important is rebalancing, regular checking and bringing back your portfolio to its original proportion. Rebalancing based on the time that we are in and absolutely based on your personal dynamics. Not only does this disciplined routine assist in risk control, but it also allow investor to lock in profit systematically and invest in battered asset in down phases. Number three, let's talk about liquidity. So maintaining liquidity is one of the strategies that can help reduce the impact of market volatility in your portfolio. One of the other key measures in turbulent market is to maintain liquidity. We know that maintaining a cushion corpus, let's say an emergency corpus of 3 to 6 months through instrument like liquid funds, saving account balances, etc., and avoid selling long-term assets before maturity. Other than that, in terms of investing, when it comes to liquidity in investing, is a part of your portfolio and should be part of your portfolio in money market instruments or a short-term debt that offers solidity and flexibility in taking advantage when market picks up. Liquidity, however, is simultaneously in some manner a cushion and leverage on opportunistic investing in the sense when there is a market turbulence and assets are available in market cheaper than its original value. If you have some liquid asset with you, you can definitely encash and buy the the most low-hanging fruit and have that asset in your portfolio. So these were the main three strategies that can be used to withstand and overcome the market volatility so that you have a long runway in your investing career. And to summarize this, to withstand market volatility, always diversify your portfolio, ensure proper asset allocation and rebalancing, and maintain liquidity. And last but not the least, adopting the long-term approach. When I say long-term approach, I mean one of the most underappreciated volatilities to overcome is patience. Emotional reaction such as panicking and selling when they are declining in price. This can lock in losses and inflate your long-term goal. It can push your long-term goals further. Instead, remaining disciplined and focused on long-term goals allow investor to ride through short-term anomalies, short-term issues. Market have always recovered after all the corrections. We know historically this have been the case, right? Rewarding those who held those positions and continue with those assets are always being rewarded. Investors are able to survive volatility and emerge stronger as you experience volatility and various market cycles. Hope this video was useful and of some value to you. Thanks for watching. Happy investing.